Hey, imagine you buy a home in Florida because of sunshine, palm trees, and that breeze off the sea. And then you realize your biggest threat isn't theft or taxes, but water, wind, and rules you never saw coming. That's exactly the story unfolding right now in Florida, where hurricanes, new laws, and shifting markets are rewriting the dream. If you're thinking of investing, buying, or even holding property in Florida, this script is your map through the storm. This year, the storms have already tested the state again. Hurricane Erin emerged in the Atlantic, stirring waves, flooding low-lying coasts, and reminding everyone how precarious coastal living can be. It never made landfall, but the damage it left in terms of fear, insurance claims, and saltwater intrusion was real. And behind Erin, forecasters are keeping eyes on new tropical systems forming near Florida. Any one of them, stalled or weak, has potential to bring heavy rains, flooding, and headaches. But storms are only part of the picture. In communities along Florida's Gulf Coast, homes are sitting longer on the market. In Charlotte County, for example, homes are now entering what many call a buyer's market. 6 months after back-to-back hurricanes battered the region, sellers are struggling to find buyers. Houses once flipping fast are now lingering in limbo, waiting for offers. At the same time, the state government has pushed new rules that are forcing many storm-damaged homes to be rebuilt to a higher standard, or torn down entirely. Homes that once could be patched are now required to be elevated, reinforced, or demolished in sections. That's not just more cost, it's a redefinition of what coastal living is allowed to be. For homeowners who can't afford the upgrades, the choice is often to sell at a loss or walk away. Some neighborhoods are slowly losing their old character as bungalows and cottages give way to taller, tougher houses. Then there's policy. Starting October 1st, 2025, Florida is rolling out expanded flood disclosure laws. Sellers must now disclose prior flood damage, known flood risk, and past claims history. That changes the game. Buyers used to having faith in unseen history now have to ask new, harder questions. Realtors already had to update their contracts and forms to reflect this shift. On the market side, July 2025 data shows Florida housing is softening. Closed sales of single-family homes slid some 2.8% compared to a year ago, while condo and townhouse sales plunged more than 11%. The state's median home price is showing signs of flattening, and inventory is inching upward. The softness is subtle, like a breeze before the storm, but it's real. One fascinating dynamic, the lock-in effect is showing early signs of easing. More homeowners now carry mortgages of 6% or higher, the highest share in a decade. That means more owners may finally take the leap to sell if rates drop, possibly flooding inventory onto already fragile markets. And here's another twist. Federal flood insurance is in limbo. Because of budget or shutdown pressures, flood coverage for new policies is frozen in many parts of Florida. That means buyers in flood zones may not be able to get the insurance required by their lenders, and that freezes deals. All of this is playing out right as Florida continues to attract capital and attention. Major developments are underway, especially in South Florida. A giant real estate firm called Related Ross is pushing massive mixed-use condo, office, and retail projects across West Palm Beach, building tens of millions of square feet with big bets on future demand. Meanwhile, in Miami, the state just approved a prime downtown parcel valued at some $66 million to be given to the Trump Presidential Library in a bold political and real estate move. That deal isn't just symbolic. It's land, value, foot traffic, and controversy all rolled together. And in Naples, luxury sales are setting new marks. Just months ago, a waterfront estate sold for $225 million, one of the highest home sales in U.S. history. That's not a fluke. It signals how far the ultra-luxury tier is decoupling from the broader market. What does all this mean in story form? Picture a coastline where the rich are building ever tougher, ever newer, and ever more controlled homes buffered by wealth, while in middle neighborhoods, people are struggling with mortgages, insurance, rule changes, and a market that's losing steam. The rules are shifting, the risks are rising, and what used to be a high reward is becoming a high gamble.
Florida's real estate is no longer a single story. It's a constellation of stories. Coastal luxury, inland refuge, mid-market collapse, experimental adaptation, all overlapping, all colliding. And in 2025, the seams between them are tearing. To see how deep this goes, we need to zoom in on the places that are pivoting fastest, the new players, and where the pressure is greatest. You already know Cape Coral is ground zero. Once flamed by speculative demand, now it's headline news as the worst housing market in America. Home prices there have dropped over 11% in the past 2 years. More than half of listed homes have seen price cuts. Nearly 8% of homeowners are underwater. Builders are abandoning half-built shells. The glory days are gone. This isn't a temporary stumble. It's a structural unraveling. Many in Cape Coral are grappling with whether to cut losses, hold on and hope, or walk away and leave their homes to insurers or banks. That kind of trauma doesn't heal overnight. Yet not all of Florida is collapsing. Some places are doubling down. In West Palm Beach, a real estate titan called Related Ross is writing Florida's next chapter. In 2024, Stephen Ross launched Related Ross, and now the firm is pouring billions into mixed-use, condo, retail, hotel, and office projects across Palm Beach County. Their bets are bold: 1.4 million square feet of residential, 700,000 retail and restaurant, 870 hotel rooms. They envision a kind of new mini downtown spine, stretching through suburbs and connecting nodes. The vision? Densify, elevate, reimagine how people live in South Florida, but thicker, more vertical, more resilient. The ripple is clear. When a firm this size moves, neighborhoods adjust. In Miami, politics and real estate are converging dramatically. Florida just approved a transfer of 2.63 acres of prime downtown land, valued at $66 million, to the Trump Presidential Library Foundation. That property, adjacent to the historic Freedom Tower, has ignited controversy. Critics say it's a political maneuver more than a cultural project, but the real estate implications are undeniable. A major institutional footprint, foot traffic, upgrades, prestige. That parcel will reshape nearby values, zoning, and expectations. Miami is not just a coastal city, it's a battleground for symbolism, capital, and power. At the same time, new laws and policies are squeezing middle-market homeowners. Voters overwhelmingly passed Amendment 5, tying Florida's homestead exemption to inflation. The stated goal? Relieve homeowners from runaway property tax increases. But in practice, this tends to help wealthier homeowners more than middle-income ones, and it further constrains local government budgets already stretched by insurance, sea-level adaptation, and infrastructure maintenance. Meanwhile, counties and cities are ratcheting building codes, flood mandates, elevation requirements. In some storm-prone zones, simple repairs may no longer pass code unless you upgrade foundational systems. That means many homeowners in vulnerable zones are facing massive retrofits or forced buyouts. We also see a subtle but serious shift inland. Take Ocala. Once relatively under the radar, Ocala is now being spotlighted as Florida's most affordable city for homebuyers. Its median home price hovers around $303,575, nearly 58% cheaper than upscale regions like Naples. Ocala's equestrian culture, open landscapes, and lower risk from storms are drawing attention. It's not a beachfront boom, but in a fractured market, inland affordability becomes a magnet. People priced out of coastal markets are now asking, how far inland can we go and still retain Florida's lifestyle? The answer is shaping new migration corridors. Across the state, Florida Realtors data for July 2025 shows a market in flux. Closed sales of existing single-family homes fell about 2.8% year-on-year, while condo and townhouse sales plunged nearly 11.8%. The median price for single-family homes sank to around $410,000, down 1.7%. Condos took a heavier hit, a 6.3% drop. Inventory is rising, a 5.4-month supply for single-family homes and 9.6 months for condos. It's not a crash, but it's softness, and it gives buyers newfound leverage. The days of instant bidding wars are fading. Prices are more negotiable. Sellers must fight for attention again. That rising inventory has ripple effects. Homes now sit longer on market. Buyers take their time scrutinizing insurance, flood maps, cost of repairs. The lock-in effect, owners holding low-rate mortgages, is loosening slightly as more people have 6% or higher rates. Some of those are now considering a move if they can find someone to buy their home in today's tighter market. That could push more supply into the market, further tilting power to buyers. the condo crisis continues to worsen. Many older towers along the coast, especially in Miami-Dade, Broward, and Palm Beach counties, are now burdened with repair liabilities. The Surfside collapse still echoes through permit offices and HOA board meetings. Some buildings are deemed unfinanceable. Buyers walk away because the repair assessments are daunting. The ripple undermines the entire condo ecosystem, which once was the affordable pathway to coastal ownership. Insurance is the choke point. Florida's home insurance premiums are among the highest in the country. Some insurers have exited entire zip codes. Others raise deductibles or refuse coverage for storm damage. For coastal homes, the cost of keeping insurance is becoming a deal breaker. And then there's the federal side. The NFIP is facing expiration. If Congress fails to renew it, new policies may stop, crippling home sales in flood zones where mortgage lenders require flood insurance. Homes can't be financed, deals fall apart, markets freeze. Climate science adds deeper texture. Recent studies show that mangroves play a huge protective role. In Collier County, scientists estimate mangroves reduce storm surge losses by $67.5 million annually. Their effect is not uniform. Landward of mangroves, losses drop. Seaward, nuance matters. But the message is solid. Green infrastructure is not cosmetic, it's monetary. In zones where mangroves remain, properties are safer. Where they're destroyed, exposure skyrockets. That adds another invisible line inside neighborhoods, one in which nature becomes your co-protector or cost center. In South Florida's luxury market, something else is happening. Despite all this risk, the ultra-luxury tier continues to defy gravity. In Manaplan, near Palm Beach, a $49 million estate sold recently, the top U.S. home sale that month. In February, 4 of the priciest U.S. properties were in Palm Beach County. Miami and Palm Beach remain leaders in U.S. luxury real estate, even as storms and insurance swirl around them. That tells you that for ultra-wealthy buyers, factors like legacy, tax benefits, global capital flows, and prestige often outweigh local risk. Yet, it's no luxury bubble without cracks. Analysts now rank Miami as the most vulnerable real estate bubble globally. The city's score is 1.73 on UBS's index, well above the high-risk threshold. Why? Rapid price growth despite weakening demand, deteriorating affordability, rising ownership costs, and the ever-present climate risk. Homes are lingering unsold. Many are being discounted. The balance sheet is strained. Miami might still be a magnet, but even magnets corrode under extreme stress. Meanwhile, in Boca Raton, a new wave of apartment developments is reshaping the rental landscape. Developers are planning some 7,600 new units across Boca, higher density, flexible living, walkable amenities. The target? Younger renters who want Florida living, but not homeownership under heavy risk. The shift signals a pivot away from homeownership towards renting as the safer, more flexible option in high-risk zones. So what's this all adding up to? A fracturing map with multiple layers. Coastal luxury, still strong, but under pressure. Buyers here have financial firepower to absorb insurance costs, repairs, and taxes. They hedge risk. Mid-market and coastal condos, struggling to survive. Many are becoming liabilities. Risk-aware inland markets, gaining interest. The safety premium is rising. Developers and policy, re-engineering Florida with denser, resilient, mixed-use plans. Insurance and federal programs, the linchpins. If flood insurance fails or insurers pull out fully, many coastal markets freeze. Natural infrastructure, mangroves, reefs, wetlands, no longer optional. They're part of the value equation. In Florida, living is far past the point where home value depends only on square feet or location. Now value is also a function of elevation, nature buffers, repair burdens, code compliance, and policy shifts. The invisible lines, flood maps, wind zones, protective mangrove belts now matter more than zip codes. We see the beginning of a new reality. In Florida, the choice isn't just where to live, but what kind of exposure you accept. Some will choose luxury with risk. Others will retreat inland. Some will shift to renting. The state's map is changing, not just with new buildings, but with new fault lines.
Florida is not collapsing. It's not thriving. It's transforming. That's the story we've been following, and now we arrive at the hardest part, the future. Because the real question is not what's happening today, but what happens next. The state has reached a point where real estate value is no longer measured just in bedrooms, square footage, or even zip codes. It's measured in resilience. It's measured in insurance eligibility, flood history, wind-resistant design, and even whether mangroves still protect the shoreline behind your house. Florida is becoming a case study in how climate and economics collide. And for every market that rises, another slips. Let's imagine two Floridas in 2030. In one, Naples, Palm Beach, and Miami's high-end corridors are stronger than ever. They've fortified with seawalls, drainage, and stronger building codes. They've invested billions to adapt, and they're magnets for the global elite. Billionaires treat hurricane shutters like accessories, and insurance costs are folded into the price of luxury living. These zones thrive not because they're invincible, but because they're desirable enough for wealth to absorb the risk. But travel inland or north, and the story changes. Cape Coral still carries scars. Tampa's housing market has never fully regained its pandemic highs. Orlando is stuck in a slow cycle of oversupply and underdemand. Old condos dotting Miami's shoreline are emptying, their owners crushed by repair bills or unable to find buyers. In some neighborhoods, for sale signs sit in front of buildings that no bank will finance. The dream of the Florida condo, once the affordable entry ticket to coastal life, has eroded into a cautionary tale. The key pressure point, as always, is insurance. By 2025, premiums in South Florida were already doubling and tripling, families paying more than their mortgage just to stay covered, and when insurers pulled out, the state stepped in with Citizens Property Insurance, but even that system is strained. Every new hurricane season adds billions in claims. If another Category 4 or 5 storm hits the Miami Metro or Tampa Bay head-on, the fallout could ripple through every policyholder in the state. Without stable insurance, financing collapses. Without financing, transactions freeze. That's not a housing market, it's paralysis. Federal flood insurance is no safer. The National Flood Insurance Program is once again on the brink of expiration. Every time Congress stalls, thousands of Florida home sales grind to a halt because buyers can't get the flood coverage their lenders demand. Imagine trying to close on a home only to hear your policy can't be issued. Deals die, confidence evaporates, and each political game in Washington plays out like an earthquake in Florida's housing corridors. So, where does opportunity still exist? The answer isn't simple, but it is clear if you read between the lines. Inland cities like Ocala, Gainesville, and parts of Central Florida are emerging as havens. They're cheaper, safer from hurricanes, less reliant on flood insurance, and still carry that Florida lifestyle. These aren't glamorous markets, but they're resilient. For families chasing affordability, these places represent survival. For investors, they represent stability. But inland growth creates its own risks. Infrastructure in those areas wasn't built to handle mass migration. Roads, schools, utilities, they will all strain under new demand. And that means costs will rise there too. The ripple effect of coastal retreat is inland pressure. You don't escape the storm, you just trade one risk for another. Developers are also rewriting the script. In Miami and Palm Beach, luxury towers keep rising. Related Ross, one of the biggest new players, is building entire districts of condos, offices, retail, and hotels. Their vision is vertical Florida, denser, stronger, richer. These projects represent belief in the future, but they're also bets that the wealthy will never stop coming. If that assumption holds, luxury thrives. If it falters, billions are on the line. And let's not forget politics. Florida just approved handing a $66 million downtown Miami site to the Trump Presidential Library Foundation. That single move symbolizes how real estate here is inseparable from politics and identity. Property isn't just an investment, it's a statement, a weapon, a legacy. Every zoning decision, every development deal, every flood disclosure law is wrapped up in Florida's political theater. That makes the market even harder to predict. But the sharpest line dividing Florida's future is confidence. Real estate lives and dies on belief. People buy when they believe tomorrow will be better. They sell when they believe tomorrow will be worse. Every storm that tears off roofs, every insurer that exits the market, every condo board that announces a $100,000 repair assessment chips away at that belief. And once belief breaks, it takes years to restore. Here's the forecast. Florida will not disappear. It will not crumble into the ocean, but it will split. Wealthy enclaves like Naples, Palm Beach, and parts of Miami will become even more exclusive, fortified, and expensive. Middle-class markets on the coast will struggle, some fading entirely. Inland cities will rise, drawing those priced out or storm-weary. Condos will remain fragile, their survival hinging on costly retrofits and insurance reforms, and insurance itself will be the ultimate gatekeeper, determining who can live where and at what price. So if you're watching this from the outside, thinking about buying in Florida, here's the truth. The dream is still alive, but it's no longer the same dream. It comes with a contract, written not in ink, but in water, wind, and policy. If you can afford to play at the top, you'll always have options. If you can't, you'll need to be smarter, faster, more cautious. You'll need to understand elevation maps, flood disclosures, insurance fine print, and policy shifts. Paradise is no longer free. It comes with homework. In the end, Florida is the front line. It's where climate, wealth, and politics collide first. And the outcome here will echo across America. Because what happens in Miami, Naples, or Cape Coral today could be what happens in New York, Houston, or Los Angeles tomorrow. Florida is not just a state, it's a preview. And the preview is telling us the housing market of the future isn't just about what you can afford, it's about what you can survive.